Welcome to the ESPC Property Show, and today we're going to be talking to Paul and Dave from ESPC Mortgages. Everything you need to know about mortgages. Since the last time we told you everything you need to know about mortgages.
Yeah, exactly. We cover a lot of points, and it's really just an update on what's happening in the mortgages market, and a little bit more, shining a bit more of a light on what is bringing a lot of doom and gloom in the media.
Yeah,
lift that ever so slightly.
We dispel some myths, and I think there was some really good points made. That the thing I took home from it was two things. One, lenders are very much open for business, and it's never been a better time in some ways because they've got more time to service these inquiries and give you quick decisions, which is always a real plus. Mm-hmm. And there's the point that was really well made is that money you put aside for the premium you're going to have to pay on a property, potentially now you can use for your deposit, so you can get your repayments down.
Yeah, so without further ado, we'll pass you over to our chat with Paul and David. Okay, so we're here with Paul Demarco and David Lauder from ESPC Mortgages, who've been on the podcast before. So Hi guys, I don't know if you want to do a little intro to yourselves?
I'm David Lauder, one of the mortgage advisors at ESPC. Been here for 18 years for my sins, and just deal with all the main clients that we deal with for mortgages and protection.
Perfect. Paul?
Yeah, likewise, I've been around for 18 years as well. Another mortgage advisor, work alongside David, and see all the clients that require a mortgage and protection.
So just to kick off, obviously a lot's been going on in terms of mortgages over the last year. So what is the current market kind of situation like?
The current market at the moment's a bit quieter. I think, though, to be fair, that's traditional. When people are on summer holidays, school holidays, we've always found that to be a bit quieter. But it's probably a little bit more quieter than normal. What we don't know is when and how much that will pick up. We're still getting plenty of inquiries. And obviously we're dealing with a lot of our own clients that mortgages are due to end, and we're trying to review those as quick as and as early as possible.
Yeah, we'll come to that. That's a timing thing, isn't it?
And some lenders are more sympathetic to that as others. So we're dealing a lot with that, and obviously still dealing with clients that are looking to buy houses, but admittedly that is a slower, less active process.
Yes, and probably more than ever before, people are interested in what the Bank of England's got to say. It used to just pass by, but now everyone's there, aren't they, on the day that they're reviewed to see, and I'm sure those are the days that you're busy. Shall we talk about the type of mortgages that are available right now then in the mortgage marketplace? We did a podcast just the other week, didn't we, Megan? And we were talking about the difference between the market in 2009. You guys will remember that. And the market now is, there is availability of mortgages. We don't have a credit crunch. We have higher rates than we've been used to, but we don't really have a credit crunch at the moment, do we?
No, we certainly don't have a credit crunch. However, obviously interest rates are very high just now. It's been like a little bit of a roller coaster, because if you look at the rates, at the beginning of October, September, they went up quite substantially, and then round about sort of January time they went down again, and now they're kind of back up, and I'm hopeful that they've peaked at this point. The fixed rates I'm referring to here, you're looking at probably on average about sort of 6% for a 2-year fixed rate, and maybe 5.7, 5.6, 5.7 for a 5-year fixed rate. So it has been a bit of a roller coaster with the interest rates.
Mm-hmm. Okay, because we were talking about sub 4%. I remember having that discussion, might have been the start of the year, but those rates have gone at the moment.
Yeah, I don't think you'll see 4s for quite a long time. The rates that Paul's talking about is right, but some of those are even higher if you've got a higher loan to value. I think the slight small green shoot at the moment is that they have stabilised, and we have actually seen lenders not frequently but offer reductions in mortgages slightly, which we weren't even seeing those for the last 6 months.
Sure.
What we hope is that will be a trend that will continue. Might be slow and sure, but hopefully it will continue. But the flip side of that is the Bank of England, as you mentioned, Paul, and the base rate, which probably I think it'd be fair to assume that there'll be at least one more rise this year, but that doesn't always have a direct correlation with the mortgage rates. It's more swap rates that the mortgage lenders work from, but obviously we're not going to lie, a base rate rise is not a good trend for interest rates.
Sure. Yeah, absolutely.
Yeah, and so if somebody is coming maybe to the end of their fixed term and looking, how far ahead should they be considering their next mortgage?
Yeah, well, most lenders are now 6 months. Some are still 3, believe it or not, but it does vary between 3 and 6 months. So that's kind of what you're looking at. We are actively now approaching the clients whose mortgages are about to expire 6 months from now to explain the circumstances to them, and if they want us to look at the mortgage just now. Obviously, the good thing about the product, what we call a product transfer, if you stay with this existing lender, what majority of lenders will do, and this is the majority, not them all, is that if you lock into a fixed rate just now and it's got 6 months to run on the mortgage, we keep an eye on the rate in case it does decrease. So let's say we're 4 months down the line and the rate has dropped, we can then get a re-offer on a mortgage if the rate does decrease.
Sure.
That's not with every lender, but that's with the majority of them.
Okay, that's interesting. And I think there's this, which is a good point then when you talk about every lender, and you sit here as two mortgage advisors, probably a valid question to ask you is, why should somebody come to yourselves as opposed to simply just doing a remortgage through their existing lender?
Well, we're independent, which is a big selling point, which means we can deal with all the main banks and building societies, and everybody they speak to, it's not one size fits all. It's a solution very much tailored towards their circumstances. So what I mean is that there will be different lenders that will be suited to different people's circumstances, and we've got the ability to basically go down like a funnel, and at the bottom you get the answer. But what you're getting is you're getting the best solution suited to your circumstances. If you're just going to your own bank, trying to arrange it yourself, the chances are that it wouldn't be absolutely the most competitive, and it's, using a football league analogy, might be halfway down the league as opposed to at the top of the league. So the other thing as well is you're actually dealing with people, professionals that actually do this day to day and can be aware of a number of things, because there is a lot of sort of things that you need to be aware of that maybe if you don't have a full knowledge can be quite tricky. So it's just trying to have peace of mind, I guess.
And would you say lenders are asking, so if you're with an existing lender, is it straightforward, or are they now saying, okay, well, your income was that then, what's your income now? Are we almost starting again here these days?
No, that going back to Paul's point of what we call a product transfer, where you've got a mortgage already, but your deal's coming to an end and you're wanting another next fixed rate. If you're choosing to stay with your same lender, then to be fair, there is no real assessment done. It's not a given. We've got the client has to give us basic information, so we're doing our due diligence and duty of care to the mortgage lender, but the mortgage lender is not doing any assessment if you're not changing the amount of the mortgage or the term of the mortgage. So from a hassle point of view, peace of mind, it's a good journey for the client. If they're wanting to change something or go to another lender, then it's a full assessment. Yeah,
and there might be a good reason for doing that.
Correct, yeah, absolutely.
Yeah, absolutely.
Or there may not. Yeah.
There is another point I want to make regards why use a mortgage broker. With a mortgage broker, it's usually 1 or 2 points of contact. Easy access to the broker itself, where if you went direct to, say, a bank or a building society, nobody likes calling help desks because of press 1, press 2, press 3, and sometimes you don't get through. Whereas at ESPC Mortgages anyway, you will get right through to the individual person, and that's a big, big plus in my opinion.
Yeah. You are press 1, aren't you?
I'm press 1. I'm press 1. There is only one.
There's only one button.
Yeah. And like you said, Paul, if you work with a mortgage advisor, then they can see when your mortgage is coming to an end, and you guys get in touch with them. Absolutely. It's kind of that ongoing support. It's not just once you sign your mortgage.
Exactly. It's not missed. I mean, we contact all our clients, when their deal is coming to an end, to offer them the best deal, whether it's what we call, as David alluded to earlier, a product transfer or even a remortgage as well.
And what I'll also say, I think what you were alluding to, Megan, is that we don't just do that once. So mortgages are in tranches, and once you take a tranche, which is like a 2-year fixed rate, 3-year fixed rate, 5-year fixed rate, when that deal's coming to the end, it's getting reviewed again by ourselves. So you're basically building a relationship, but you're also finding the best mortgage mortgages during the whole term of the mortgage, because it's not just the best mortgage for the first 3 years, it's maybe the best mortgages over the next 20, 25 years.
Okay, Megan and I, huge champions of first-time buyers. Shall we talk about first-time buyers?
Yeah, so it's obviously a very difficult time to get on the ladder. I don't know if you guys want to talk about what the options are for first-time buyers right now.
And give us some good news stories.
Yeah,
Well,
exactly.
There is good news stories because, for example, in Edinburgh particularly, you are getting probably more house for your money. So there is not as much money to bid over the valuation.
Yeah. Fixed prices.
Offers around the valuation, and it means that £20,000-30,000 is not just being used just to get the house. So okay, the monthly repayments may be a little bit more, but they need to think about the amount of money they've actually saved to get the house, which will probably, in my opinion, probably be more than what they're actually having to pay per month. The other things I would say as well, which probably not a lot of people realise, is that the lenders, because of the interest rates, are nowhere near as busy as what they normally are. And what that means is they've got an appetite for business, they've got their own figures to hit, which they have to hit at the end of the year, and they will, be competitive, but also their service levels for placing cases, getting a quick yes, getting a quick no, is a lot quicker because cases are being looked at a lot quicker as well. So when in the busy times of a year to 2 years ago, from application to mortgage offer, it was a lot longer process. In terms of their strictness, it's not really any, although the rates have gone up, the strictness isn't any different for any other times. What's just changed is the stress test of affordability has just gone up because we're stress testing against higher interest rates.
Yeah, another point to make as well is that a lot of lenders are now increasing their maximum term to 40 years. So the reason for that is for affordability reasons and to assist the client as well. I mean, if you're 30 years of age or under, it's an option you can have, as most lenders will take your mortgage to 70. Some take it to 75, so you could be 35 as well, but that's to help the clients as well. And I've noticed more and more lenders are offering this facility to 40 years now.
And are you, when you're talking to a client, because back in the days 20, 25 years was standard, are you offering 30, 35, 40, or do you show them the differences? Because whilst it's longer, it means you are paying this thing back over a longer period.
I think what you do, Paul, and it's part of giving advice, is that, like, Paul's very right to mention that, but I don't think I would champion it, if that makes sense, because the amount of interest that you end up paying back is a lot. I think the way I focus on it is I want the client to pay back their mortgage as quickly as is possible, but affordable. And if you can avoid 40 years, then yes, you want to avoid it. But equally, if it's a difference between getting the house and not getting the house, and get on the market and getting to pay towards it, then it's a good option to have.
As you said, it's tailored, isn't it? Every
tailored.
Case is going to be different. Every client is going to be different.
Yeah, absolutely.
So there is also obviously the new 100% mortgage that is available. It was introduced by Skipton, wasn't it? Is that available anywhere else? Or is it still just Skipton that are offering that?
My understanding just now is it is still Skipton.
Okay.
It does have stipulations with it. One of them is that you have to be renting. You can't live with parents. And I think you've got to be renting for a year.
12 to 18 months.
12 to 18 months you need to be renting for, and it's to prove you can actually afford to pay rent, so hopefully you can afford to pay a mortgage, so you can show some sort of history of affordability. And it is only Skipton just now, but the credit check for that will be quite tight as well. I haven't done any personally so far, but it is a good facility for someone who doesn't have a deposit, or maybe just has enough for lawyers' fees, and maybe I don't know, has to pay a little bit of stamp duty as well. Sure. So it's good for that point of view.
There's a lot of common sense to it, because your mortgage payments cannot be more than what you're paying in rent.
Okay, so
this is showing already a track record. You've already done that.
Yeah.
You've got to be 12 to 18 months, as Paul says, but it's available to a wide array of 8 levels of income, because please forgive me if I'm wrong, but I think you can actually borrow up to about £600,000.
Yeah.
Oh,
So
right.
like there's a lot that you can help a lot of people. It's not just for lower income people.
Yeah.
It's for a lot of people.
Yeah.
And
The interest rate isn't cheap though, is it? Let's be honest here.
well, the interest rate's not cheap. The interest rate for any mortgage is based on loan to value, and loan to value is how much money deposit you can bring down. So yes, it won't be cheap. It'll be definitely in excess of 6%, maybe even closer to 7%.
Yes, it's actually slightly higher than 95%, but there's not much in
Sure.
it. So that's with a 5% deposit.
Yeah, so you're putting down 5%, your interest rate is lower, you put down 20% or 10,
lower,
15,
again.
20,
Yeah.
25,
Of course.
basically.
Up to generally up to
40.
40% is your kind of pretty much your lowest
Ceiling
interest
point.
rate you
Sure.
can get as a ceiling
Yeah.
point. Yeah.
And what's, in terms of first-time buyers, again, we talk about the things being tailored, but what's the common deposit that you're finding now? And is some of that money coming from Bank of Mum and Dad? And can you have some deposit coming from the first-time buyers and some coming from Mum and Dad, so you're putting two into the same pot? Is that cause any issues?
No, not really. You can have family gifts, blood relation gifts. Gifted deposits can cause an issue if they're not generally from a blood relation or...
Blood relation sounds
yeah,
quite...
yeah,
No one has to do a blood test here, though, do they?
No. Like mum or dad or brother or sister.
Okay,
Each lender has its own different criteria, but in general, the answer to your question is you can have some savings and some gifted deposits as well.
What I would say to you is that I think they're absolutely fine with gifts, and it's a very common thing, Bank of Mum and Dad.
Yeah.
I think what they do look to do though is they also want to see a commitment from the clients themselves.
Okay.
And what I mean by that is that they've
You've
been
been
able
saving
to
or
build up
Yeah.
some savings, and
Yeah.
it's not just all that way being done. So you can have a bit of a mix and match. Your case will be stronger if it's coming through your own savings, but certainly gifts to Mum and Dad are perfectly acceptable.
Yeah. Sorry, you did mention the loan to values. In general, the majority of clients that kind of we see, I'd say, are definitely not 95% or 100% mortgages. They're mainly 90 and down.
Sure.
And a lot of them do come from mum and dad, but a lot of good savers as well.
Good, yeah, no, it's good to hear. What about a situation where maybe someone's credit worthiness, maybe they've had late payments on a credit card or anything worse than that, where there's been a judgment against them? Are they difficult to place right now? Is there any hope for some in those situations?
They are difficult to place, to be really honest with you.
It comes down to the overall profile of the case.
It does. To be perfectly honest with you, there are specific brokers that can specifically deal with cases like that.
Yeah.
The majority of mortgage brokers probably, I'm not saying they don't like people with CCJs or defaults or anything like that, but there are specific brokers.
It's quite specialised.
Specialised
Okay.
who can. So we can help them. We can refer them on
Sure.
to individual companies like this and try and find a home for that. But they are quite difficult to place with a mainstream lender.
Sure.
But the only thing I would say, sorry to interrupt, is I would say if it depends on what the CCJ is. So if it's under £500, and if it happened for like a month and then it was satisfied, and there was a valid reason like a lack of communication with a potential provider, or like there was a family situation or something, it can as a one-off be looked at sympathetically. But if it's something that is a track record, that it's happened more than once and there's a number of things and there's a trend happening, then yes, it will be a challenge. And in many ways it's quite right that it's a challenge as well, because they'll take the view that, well, if it's happened here, who's to say it's not going to happen to the mortgage?
And in some ways they need to be a responsible lender, and equally as a borrower you need to ensure that you can afford these things. So I suppose the message there is talk to you guys, really, but be completely transparent, because it will come out, won't it? These things will be found out.
It definitely will. There are certain lenders, obviously, that have got a more pragmatic view towards that. So, as David said, small arrears, maybe late payments, you sometimes have to just get a credit report. If they haven't already paid the small debt off, say it's 50, 60 quid on a mobile phone, they maybe switch contracts, and maybe one of the mobile phone contracts didn't write to them and moved address, and it went into the abyss sort of thing. That kind of thing, as long as they pay it off, is usually okay.
Okay, good, thank you.
And in terms of people who currently have a mortgage, if they're struggling with repayments or anything like that, what kind of advice would you give anyone in that kind of situation?
Well, with the new charter, the lender is a little bit more sympathetic. They can do things like they can transfer your mortgage. Not ideal, by the way, and these things that I'm going to talk about are pretty much last resort. But they obviously have to contact their lender. If you feel you're ever in trouble with your mortgage, you don't hide. You don't put your head in the sand. You've got to call your lender immediately. Obviously, the advice we would give is the same as what I'm going to tell you now, where is that the lender would try and help you and maybe put you on interest-only payments to start with, and that's just one of the things they can do to sort of assist you. Increase the term to keep the payments down, keep it on repayment is another one. I think some lenders now, David, are allowed payment holidays for 6 months.
And that means you're not paying the mortgage.
Not paying it, but the debt is added on to the loan. It's
accumulating.
secured against the loan, it is. But then again, hopefully that helps. Say someone has maybe been made unemployed or something like that. So these are things lenders can do. And my advice to you is, if you're really struggling to pay your mortgage, you have to speak to your lender. It's very important.
Yeah,
I
absolutely.
mean, basically, there was a government charter that came out with all these interest rates where not all lenders more or less committed to it.
Yes.
And the things that Paul's talking about is what they're sort of committing to. So you would contact your lender, and it is in their interest to act sympathetically. Lenders don't want to repossess houses.
No.
Nobody wins in that situation.
No, so they will act as sympathetically as possible.
But I think this is the difference between what we saw in 2009, where there was a lot of repossessions. Yeah. But in saying that, beforehand there'd been a lot of reckless lending. Now we've not seen reckless lending, because you guys, for all those mortgages you've signed up in the last, since 2009, 13, 14 years, there's been stress tests and there's been things done. So there's been responsible lending. So we shouldn't be seeing the levels of, we're not seeing those levels of repossessions. But it's a good question, absolutely. Yeah. Okay, well, I think we reached crystal ball time, Megan, really quickly.
I'm sure you're both very excited. We were going to ask what the kind of outlook is for the months and maybe year ahead.
Not financial advice we might have.
I mean, it depends what you read, doesn't it? I mean, it's the last 4 or 5 months have been so turbulent. I don't think we'd have predicted we'd be where we are at the moment. I think there'll be at least one base rate rise between now and the end of the year. I wouldn't rule out two. I think after that there'll be a period of stability, and I'd like to think in 2024 we'll see a gradual decline in terms of base rates and interest rates. I think there's still a good appetite for lenders to lend business. I think what we don't, the unhidden part for 2024 is basically consumer confidence. And what I mean by that is, do they feel like all this bad news has sort of put them off? But what I think they've got to bear in mind is that there's also a potential window of opportunity. And the window of opportunity, as I alluded to earlier, is getting more house for your money. Because it could become, from always being a seller's market, it could slowly start to swing to a buyer's market. And I think that's long term, that could be a good thing for people in Edinburgh, because how Edinburgh prices traditionally always do really well.
I think you're right. I mean, we've spoken for a while now about a more balanced market, which is what we're seeing between a fairness between buyers and sellers. And it's a really interesting point that you make about that opportunity for buyers to go out now and find themselves not paying the premium they were last year. And we know there's no bell that ever goes off at the bottom of the market or the top. So it's about when it's right for you, isn't it? Really?
Yeah. I mean, it is, because the other thing you've got to bear in mind, particularly for first-time buyers, is that if they're paying £800 a month in rent, they're paying somebody else's mortgage.
Yeah.
So at least if they're on the property ladder, regardless of the interest rate, that £800 is going towards their future, and they're tackling the mortgage debt.
Yeah, I remember seeing this calculation. I can't do it off the top of my head, but as you say, at that level, it's £9,600 a year.
Yeah.
That's £96,000 over 10 years. That's £192,000 over 20 years that you're paying to somebody else when you could have...
Despite rents being slightly less than the average mortgage now, it's still better to buy, because, as you rightly said, Paul, that you're paying the landlord a lot of money over the next so many years. So definitely best to buy.
Yeah, but again, it's circumstances, isn't it? You know, if you're going to be in the city for 2 years, by the time you've paid your LBTT and everything else, you might be better renting. So it's taking a view.
It's not one size.
Horses for courses, yeah, absolutely.
You've got to look at it over a period of time, haven't you? And what's your timeline for that? Sure, it's the same with fixed rates. You know, do you want to lock a guy, somebody in for 2 years or 5 years or 10 or? Can you get lifetime fixed rates these days?
You can actually, you can. You can even get flexible fixed rates as well, which means you've not got any penalties. There's not very many of them on the marketplace, but I'm going to be doing one.
Lifetime fixed rate?
Not a lifetime fixed rate, no, it's a flexible fixed rate.
So with a flexible, it's never more than that, but it could be less, is that?
No, it's a fixed rate with specific lenders, not many that do it. So say it's a fixed rate 6% for 2 years, but you can actually pay off all the mortgage at any point and jump off it if the rate goes down, or say you only want, you think you're going to inherit money in a year, or you've got another house to sell, but you're not going to sell it for a year. Lenders are fine with that, the ones that do these flexible fixed rates, and that's kind of pretty much why they do them, and then you can just pay the whole mortgage off or drop it down by half.
Okay, good. Yeah, I think the lends have certainly become a little bit more flexible, as you can say. There's a lot more creative.
There is creativity,
sides, and
but I mean, a lot of it's down to more. I think I always simplify it by saying it's down to the life intentions of the person, and their attitude towards risk, and like what they also can afford, and what they might be wanting to do in their house in the next 2-3 years' time, and also like how much they need stability against willing to take a risk with interest rates, etc.
Yeah, I mean a good example of one is, say someone has a £400,000 mortgage. Okay, now currently, and it's been like this since about sort of October time, 5-year fixed rates are cheaper than 2-year fixed rates. Okay, that's across the board. Okay, so as David said, it depends on the person's attitude to mortgage risk. So do you want to really lock into a 2-year fixed rate because it's higher, although
peace of mind, that's how much I'm paying,
or do you want to go 5 years where you know you're definitely paying it, it's less to start with, how much less is it, what's the chances of the mortgage rate coming down in 2 years as opposed to it not? So you've got to take all these factors into consideration before you make the recommendation.
Yeah, very wise.
Perfect. Just to wrap up, I was just going to ask, is there any questions you're getting asked frequently and you want to answer now, and you can direct people to this podcast?
They can still ring you both.
Well, we get a lot of we do get a lot of people who have just either moved here recently, where they're from the UK originally, but they've just come back. So these people we can get mortgages for, but it depends on their credit score and their credit rating. But we do get a lot of people from different countries throughout the world, and they're more difficult to actually get a mortgage for right away because of different circumstances. Majority of them do have to have a bigger deposit. So we get a lot of these inquiries just now. But to be honest with you, some we can help, some we can't. It just depends.
The most questions I get asked, which I think we've covered today, is people wanting to know what's happening with interest rates. So they're like wanting to know like how they see the future and things like that. And also, I think as well, though, they get pleasantly surprised when they speak to us about how eligible they may be for a mortgage. Because I think the one thing that's came out for this is that the press have definitely jumped on bad news rather as good news.
And as you say, don't write yourself off. I think there's probably people, I'm sure, in rented accommodation now who think they can never get a mortgage, and they would be pleasantly surprised.
They would,
it definitely will be.
Just a 10-15 minute chat to find out if that's possible. So
okay, that's a great place to leave it.
Yeah, I think so. We'll leave all your contact details in the notes for the show if anyone wants to get in touch with you guys, but I'm sure we will see you again on the podcast at some point.
We love doing them, don't we? We do it as well. I enjoy it. It's good.
Well, thank you. Thanks for coming in, guys.
All right, thank you.
Yeah, good.
So there we go. That was the mortgage update. I found that really useful.
Yeah, it was really good. If you are looking for any mortgage advice, please do not hesitate to get in touch with the guys at ESPC Mortgages. We've got a great team that are in our property information centre, so you can head to our website, espc.com/mortgages, to find out more and how to get in touch with them. And we would encourage you to do so if you're looking for good advice.
Absolutely. Go early, I think, is what we heard today, and have a chat. You may well be surprised, and those that maybe maybe don't think they could get a mortgage might get a nice surprise. But thanks for listening again as ever, and we will see you soon.
Bye.